The Chinese economy, already facing a slowdown since 2020, stands precariously on the edge of catastrophe, a situation exacerbated by Donald Trump's aggressive trade policies. Trump initiated a trade war with a 10% tariff, escalating it to 20% and then a crippling 54% total, to which Beijing retaliated with a 34% tariff, only to see Trump respond by further increasing tariffs to an astronomical 104%, a move that threatens to double the price of consumer electronics like iPhones, predominantly manufactured in China, and countless other U.S. imports, as importers would be forced to pass on these exorbitant costs to consumers, potentially leading to a $1,800, $2,000 iPhone. This tit-for-tat escalation could spiral into an infinite loop, with tariffs reaching thousands of percent, potentially forcing companies like Apple to consider the seemingly less profitable, but ultimately more stable option of domestic U.S. manufacturing at prices around $3,000. A scenario that Trump might be deliberately aiming for to reshape global supply chains. China, an export-driven economy boasting a significant trade surplus, $3.5 trillion in exports versus $2.7 trillion in imports, has experienced massive economic growth over the past 4 decades by manufacturing and exporting goods globally, a strategy heavily reliant on a weaker yuan to maintain price competitiveness against U.S. exports, who weakened the dollar to make Japanese imports more expensive and revive American manufacturing after Japan's rapid economic growth and dominance in sectors like automobiles and electronics threatened to overtake the U.S. economy, ultimately leading to a Japanese real estate bubble burst in decades of economic stagnation. While China's global manufacturing dominance, including in the automotive sector where Chinese electric vehicle companies, currently facing 100% U.S. tariffs, could decimate American competitors if tariffs were removed, has fueled its growth. Its GDP growth has been slowing, and the current trade war could push it to alarmingly low levels, 2%, potentially triggering a deflationary mindset, a far more dangerous economic condition than inflation. Compounding this risk is China's looming real estate bubble, with an estimated 65–80 million empty houses, a situation far exceeding Japan's bubble and threatening a catastrophic collapse if a slowing economy triggers mass selling and price deflation. The most severe threat to China's economic survival lies in the potential for a US-EU free trade agreement, which, coupled with tariffs on China, could eliminate a substantial portion, over 30% of China's exports, as the US and EU represent its 2 largest consumer markets, depriving China of its crucial trade surplus and the ability to invest in future growth. Losing these markets, combined with a housing crisis, could indeed mark the end of China's economic miracle, creating winners and losers in the global investment landscape, with companies like Apple potentially facing significant losses.